Everyone, my name is Muskan Arora and I'm a reporter at Markets Group. Today I'm joined by one of the leaders of the industry, Donald Pierce, the CIO of San Bernardino County's Employees Retirement System. He is known for bringing unique ways for rebalancing the system's portfolio. For the longest time, Pierce stayed away from real asset investments, and as market environment changes, so do his sentiments. Welcome, Don.
We had when I first joined, and this was early on in my career, and when I was doing my MBA um, at San Diego State, taking the courses there, I I ended up finding that rebalancing was something that I took a particular interest in. And so I had written my thesis on some of the rebalancing um, methodologies. And it only later came up when I joined SB Sarah as an opportunity to explore. And and frankly, when I the my initial effort in this was a very clunky Excel spreadsheet. And so, admittedly, the board, when I made this presentation at our offsite, which we have once a year to sort of lay out various ideas and strategies, it I think they found it interesting, but not quite ready for further review. And that all changed when I met Arun Muralidhar from M Cubed, and that he was introduced to us by State Street at the time. And one of the things about that um, was that he had apparently had a lot of the same challenges when he and thoughts that when he was at the World Bank. And so he, of course, was much more technically talented across the board, and so he had developed this platform that would allow for people to take back some of those rebalancing decisions and to manage them using a rule set, sort of math to uh, be impartial in your decision making. And so with that, that was the the jet fuel that we needed to take this back to the board. And the contribution that our consultant made, Alan Martin from NEPC at the time, he was our long-term investment consultant. He recently retired, but worked with me for I want to say almost 20 years. And dearly appreciated him. He he had indicated like, well, back tests always work, so we need to test this out of sample. And so he brought a scientific rigor to the process, and perhaps not surprisingly, since we're talking about it, it passed that out of sample test. And so I think with that, the the decision to move ahead and bring it to the board as a fully engaged proposal, and that came out, and it was initiated in 2005, and then we went live with the program in July of 2006 with our overlay partner at the time, and still with us today, Russell Investments. And I think in a lot of ways, that program only happens when I have a CEO at the time, Tim Barrett, who's my former boss and mentor, who's now over at Texas Tech. He, had a willingness to let this happen. I had a consultant who was engaged and willing to consider it, and a technology partner that made it much better than some Excel spreadsheet. So I think a lot of things contributed and coalesced in order to make the program work. And at the time that we felt that we were going to make we expected normal rebalancing, range-based rebalancing that a lot of folks use is sort of a risk reduction. It may or may not make a little bit of money over a particular amount of time, but generally speaking, you're selling assets high and buying low over time that has a risk mitigation effect. Certainly, our research showed that. And we felt that on a go forward expectation that our program would add 35 basis points to the total plan. As it's turned out, it's been much better than that. It's nearly 100 basis points. So we've had a very good run. I'm sure that it'll reverse at some point.
Now that sounds amazing. And has your portfolio been impacted by the denominator effect? And what approach have you been taking to combat that?
When you're talking about the denominator effect, it's really, I think, in relation to private markets. And we have not had the same challenges on that front, but we've definitely seen a major reduction in cash flows. So to the degree that if you think, and we probably shouldn't benchmark it against 2021, but 2021 was a banner year for distributions, but that meant that there was a lot of transactions happening in the private equity space, private market space as well. So I think from that standpoint, we don't have any particular concerns, but we have seen a much diminished capital redeploy capital return back to us. So it could become an issue, but it is not one at the moment.
Okay, that's great. What kind of strategies do you see suitable in this higher interest rate environment, and why?
So at the moment, we feel that our particular portfolio is well positioned for this. But some of it by accident, because we had thought long duration bonds were terrible investments because they were, you had really low interest rates, a relatively flat-ish yield curve, but even if it was modestly steep yield curve, it was off of a base level of interest rates that were incredibly low and did not have an absolute return level that was remotely interesting. So we were driven by a low interest rate environment into credit for a host of reasons. One is which we have a investment philosophy that is income focused. We tend to be very opportunistic, and we want to have a value tilt toward how we evaluate assets. That has, I think, led us to remain in floating rate instruments, and I think we remain there today, particularly given that we are in an inverted yield curve. And I think it's novel, since I was telling the board recently that during our last asset allocation discussion, where we effectively said that we'll focus more on implementation, really try to improve the portfolio from an efficacy standpoint rather than making shifts in the asset allocation. And that an inverted yield curve is the least compelling time to make changes, because you could have the curve shift meaningfully on you. And so we opted to stay short duration in bonds and floating rate debt and bide our time. So we could have a case where that resolves itself. But I think what's interesting is I believe in March of 2024, we surpassed the longest time period for an inverted yield curve. So we are one for the history books in a lot of different ways in this marketplace.
Absolutely. And with valuations changing with higher interest rate, are you still able to have more current real-time valuations than other funds?
Well, I don't know about other funds, but certainly higher interest rates have brought us a number of excellent opportunities, and I expect them to continue to offer a repriced asset pool that we can look at. So I'm less about other funds and more about what we're seeing currently, and higher interest rates, at least for SB Sarah, has been incredibly beneficial. I hope they stay that way.
Amazing. Could you dive deeper into why?
Yes, because as I shared before, we had issued a lot of longer duration bonds. And so we had not liked real estate for a long time because cap rates were so tight. Well, when interest rates rise, those areas get particularly repriced, so much so today that depending on how the curve asserts itself. So, I mean, for instance, I think a lot of folks are assuming that short rates are going to come down, and I would certainly put that at a much higher than the odd chance that rates go up. But there is the prospect that the long end could stay higher, and if it does, it means that those longer duration assets are going to face these longer time period interest rate pressures. And so I think from our standpoint, the ability to accrue income in this kind of marketplace is where we really are seeing opportunities, and eventually real estate will become interesting again, particularly once some of the extension, because you have a pool of assets out there, particularly in real estate, and I'm thinking less office and more multifamily, that were basically bought. They're good properties, but they were bought at a time when cap rates were much lower and borrowing costs were much lower. And so to the extent that those properties are currently getting their loans extended, but they're getting loans extended on a very short time period. And so you could see borrowers that are not as well capitalized have to give up those assets. And so we're hopeful that working with our existing real estate partners, that we will be able to participate in that marketplace along with a lot of other people. But it'll be our first real leaning into a real estate market that we have really tried to avoid for many years, and not because we thought they were bad assets, but because that the price is too high.
Absolutely. Makes sense. And within your credit portfolio, what is something that you're watching to avoid risk?
I guess we tend to look at and I'll tie it back to the discussion we had just yesterday, or not yesterday, just in the last question, which is that you have a large group of investors that have used short-term debt. And if you think about it, in 2021, if they refinanced, they got a very good low rate. And if they have a 3-year tenor on that maturity, it's coming due this year. If it was a 5-year, it'll be coming due in a couple of years. But I mean, they are running out of time. And so we think that that opportunity where borrowers who have exhausted all of their levers will be an area where we can really lean into.
Absolutely. And how would taking more risk look like for your portfolio?
I when I think about that, I would say that taking more risk would look probably more like we're getting into real estate and longer duration assets. And I mean, that'll probably feel risky for me since we haven't done it for so long, but that's that's where I would say that's the kinds of risk taking we would do at this stage. It's hard for me to get excited about an equity market that seems rather ebullient already.
Absolutely. What credit strategies do you think are working well at the moment, owing to the current market environment? And how should allocators choose their credit investments? Like, if you could dive deeper into strategies and stuff.
Um, so I currently like our lineup, which is very much a long only biased, although some of the managers will do some hedging and those sorts of things, but generally speaking, these are long first or other instruments, first lien instruments or other instruments where you're getting a very good yield pickup. I would say distressed debt is an area that I'm not that interested in, or what I guess we would call special situations, because a lot of that has to rely on this resolution of things. And it's not to say people can't make money in that,
Hmm.
because they can. I mean, the prospect that you buy debt at 40 cents and get par is always a nice 2.5 times multiple on your money, if you get it. And, but our experience has been is that you never get that. So, and never in the 4 years that they think you're going to do it. So, in general, I would say the current pay credit strategies are things that we like. We like collateral that is makes sense, as opposed to, you know, the stranger thing, just esoteric assets. We tend to not to say that people can't make money in these areas. It's
Yeah.
just not something that I feel like we have to stretch to do. I mean, honestly, I just don't feel like I have to be that heroic to invest in first lien debt and get, sort of a 10 or 11, because our discount rate at the fund is 7.25. And so the marginal utility of improving that return is not nearly as great as meeting and exceeding the expectations that our, our liabilities need.
Absolutely. And what kind of could you highlight a few red and green flags in managers that you look for?
I love this question. Um, I don't know if I have a lot of green flags, but I definitely have a red flag, which is
Amazing.
the red flag would be don't do what we ask you to do. But I think in general, the the red flags are when you have meaningful changes at the in the strategy and team. I mean, that's not particularly original, but it happens anyway. And so uh, the thing that you have to keep in mind is that every change, the manager is going to come and tell you what an awesome thing it is.
Hmm.
And, even if it's, they have no idea, but that's where I think, and the consulting industry is well aware and keeps up with this really well, is that those kind of changes have knock-on effects. They may be better for you, but they don't have to be. But the person that you're in a fiduciary trust relationship is going to try and sell you, because suddenly it's not about the investment of the assets, it's the how can I keep your business?
Hmm.
And that is we often talk about there's the business of investing and the investment business. The business of investing is, the management of the assets and doing things right by your clients.
Hmm.
Whereas the investment business is about, collecting a fee and making sure you don't lose clients. Um, so I think probably less of a green flag. In fact, I don't know if I have any, but definitely lots of red ones.
I love that. Moving on to your fixed income portfolio, the returns have been great, but I would love to understand how the Fed rates are impacting your investments.
Well, as I shared, I mean, we had a long time floating rate portfolio. And not to pat ourselves on the back, but I guess I will, is that in 2021, our fixed income portfolio, which is probably a misnomer, we just would call it credit, but our credit portfolio had a duration of 0.25 years, less than 1 year. And if you think about the aggregate, the bond aggregate, I think it was close to 7 years. So, every move, every 100 basis point move, they took a 7% hit, not, and we took less than that. In fact, we benefited from it because we got a lot of the higher income. So there are limits to how duration is measures when you're mostly floating rate. So the one thing I would say that has not stayed the same, like we were getting much better spread. I would say the spread has sort of tightened, but the overall absolute level of return that we're getting is much higher, but the spread component has definitely tightened more recently, much like the stock market run up. The risk appetite out there for any asset has definitely improved.
Absolutely. And which sectors do you think perform well when like such things are happening in the market, especially in the fixed income sleeve?
I'm always surprised, I mean, these are always good exercises to have. I mean, if you had told me that you would have a limit of housing prices and all these sorts of things that or stock that you should see, continued rent rises, but when you think about multifamily, for example, like everything else, rent increases are entirely location dependent. So in some ways, you've seen a easing of the increase in rental rates, and in some cases a reduction because so much supply came on in very specific areas, not the totality of the housing. So it's a conundrum. I wish I had a better way to say I thought this sector would do great. Not sure I have a lot to add on that particular case. I mean, we tend to look at assets on a very specific basis. And so when a manager comes to us with a proposal, it's usually at an asset level, and we can then evaluate that asset in particular. So it's much more of a bottoms up evaluation, although we do have credit strategies that we would say in general, anytime double B credit instruments get above 1,000 basis point spread, I'm very interested. And so naturally they're not there right now.
Makes sense. And any sectors or strategies here that you think aren't performing that great?
Well, I would say emerging markets have continued to disappoint. And because if you had asked me 10 years ago, here's the pricing dynamics, here's the cash flows that you would expect, I would expect emerging markets to have done much better. The dollar strength has been a just unrelenting downward pressure on performance. Those emerging market managers that have done and stayed in more dollar denominated debt or have done better, the emerging market equities have just struggled. It's just been not nearly, and it's tough because we have a globally diversified portfolio, but it is not without some wistful regret that it'd been nice if you were just in the U.S. assets. But it's the same thing that it is right now, which is that every time you look at it, you just say, well, it's always expensive. And then it just stays expensive.
Absolutely.
Yeah, I would say that emerging markets have been you would like to think at some point that that would relent, but um, certainly this cycle, this pronounced economic headwind that emerging markets have faced have been much longer than I would have expected.
Hmm. Absolutely. Thank you for answering that. How and why do you think Fed rates will impact your high yield and NAV loan sleeves?
Well, as I mentioned before, we do have a lot of floating rate debt. So I mean, at the
Hmm.
moment, we are highly in favor of the Fed staying where they are. Or, if they would like, they could go higher. That wouldn't hurt my feelings one bit.
Okay. And why could you elaborate a bit more on that? I know you've already like spoken about it a little bit, but I would love to know if you could like dive deeper into NAV loans as well.
Oh, so a Nav loan is generally speaking um, a loan that you're making against a pool of assets
Hmm.
that what you hope is at an attachment point or a loan to value point that you have a lot of cushion. So to your point, if the collateral in which you are lending against is losing value because of higher interest rates, then you just have to make sure that your attachment point is well protected. Most of the time when I see these NAV loans, and we do participate in them, the attachment points are really rather low, like, sort of 15 to 25%. So there has to be an immense amount of value erosion for the NAV loans to face impairment. Um,
Hmm.
the corollary is that you're not probably getting the the really really juicy yield, but I mean it is a well protected piece of paper, and we think that NAV loans, particularly if it's against a broader portfolio, uh, you're getting cross collateralization. So it has a lot of features that are quite attractive.
Hmm. Absolutely. And within both your credit and fixed income portfolios, like private credit and fixed income portfolio, what kind of trends are you seeing in the market at the moment?
I would say that the prospect of real estate debt collateral, uh, again, I cannot tell you how long I have really not liked real estate, and so the prospect of accepting real estate collateral now it is much closer to being actionable, at least from my standpoint,
Hmm.
because those values are getting marked much better and closer to reality. Um, my personal view is that there's still a lot of hope that people don't have to take the full write down. But eventually they're going to have to come and come clean with the value of these assets. And then in which case we'll happy to be lend against a much more properly priced asset. But yeah, I would say that's the big trend across the board is that for many well over for years we have underweighted real estate, and it feels like we're probably getting a lot closer to being able to lean back in.
Amazing. And so, like, diving smoothly into my next question, because you've already spoken a bit about the sectors that you like, including multifamily. I would love to know what kind of strategies are you eyeing now that you think of leaning back into it?
Well, we have existing partners that will look at real estate equity, and I think in that space, our first move in real estate will be with existing partners on a um, either a strategy basis where they can show us, the pipeline is amazing, and we happen to agree with that. I mean, a lot of times we would get people tell us the pipeline is amazing, and we would not agree with it. Um, um, and so I think from where we sit, the quality of the assets and most of our, again, our real estate partners are great. They pick good assets. It's much more about a price point. And so that's where our first foray into this space will be, is with our existing partners who have had to endure the slings and arrows of my abuse. So they should at least get some reward for the pleasure of, being yelled at all the time.
And the last question is from Christine, actually. What is something that you're doing which is contrary?
We still think cash has option value, and so I don't know if that's contrarian or not, but I say it often enough that it's the way I would talk about it before is that cash had option value. Because if you figure that if an asset falls by 20% and you have liquidity to buy it, and then the asset rebounds, the asset gets all the credit for, all this return that it did, but poor cash never gets any credit for actually being the thing that facilitated it. So, what's in basketball, it's like the assist, right? So
Yeah.
cash is like the assist in basketball.
Makes sense. That was an amazing answer. But that was all my questions, and thank you for answering them.